Hello, hello, and welcome. This is the Financial Turtle, the podcast for people who are done chasing shortcuts and ready to build real financial foundations. I'm here with Eric Anderson, and for over a decade, he's helped business owners, nonprofit leaders, and everyday families make sense of money, taxes, and strategy. Welcome to the Financial Turtle with Eric Anderson. And today we're going to talk about life insurance isn't a wealth plan. Why can it not be a wealth plan, Eric? Life insurance is important, but oftentimes it's misunderstood, oversold, and used in the wrong way. I've seen it on social media. And so how can we smartly just protect our family and build legacy, Eric? But how are you doing?
I'm great. How you doing today?
Doing great. I'm glad to be here for another episode and to be talking about life insurance because I do have quite a bit of life insurance. So I feel like I pay a lot going out of life insurance. I'm like, man, I don't know if my family would have known that what would they do if they really would have know how much I have, right?
Yeah, right.
So I'm like, I don't want to tell them, but like I want to make sure it's taken care of. But I know there's a lot of things on social media or talk about, the difference with like, well, you could buy term, whole life, and I know we're going to dive into this, but in IULs, right? So what is the difference between term, whole, and IUL, and what should everyday folks really consider when it comes to life insurance?
So one of the biggest things, I know because it's funny you said that, I sold you some of your first policies.
Yeah.
I used to actually sell life insurance. I used to be a manager at a company. And so one of the biggest things when I used to sell a policy was the most interesting part to me when I see all the videos, all the social media, everybody makes it seem like everybody needs to have an IUL. Like you'd be a fool to not have an IUL because of the fact that you put the money in it. Once it builds collateral, you can borrow money out of it to do all these other things with it. So when you see the videos of, hey, let's go get, which again is funny because you say this is what wealthy people do, but you have to go get a loan to get $100,000 to then put that money in and then take that money out to then go do this product, whatever. A wealthy person does not have to go borrow $100,000 or go get three partners for each one of you to go borrow $100,000 that I got to pay interest on and all that. Again, I digress when I say these type of things. But the biggest thing for me is when I watch these type of videos and I see the type of people who get excited, and not just that, the type of people who come into my office and say, I'm thinking about getting an IUL because I can borrow money out of it. It's going to build all this money into it. The part that is not factored in when you see these videos is number one, isn't enough life insurance for your situation? And number two, life insurance is not like the scam of, I'm going to help you fix your credit in order to get this loan or get this credit. Life insurance is your rating is by your health and your age, period. There's no scam in that. Your health and your age. So when an older person comes and says, I want to get an IUL, that makes absolutely no sense to me. Because again, we're not even factoring your health. We're just talking about your age. Is that wise for you to put money into something that I'm having to pay such an incredible rate for just for no simple other reason than besides my age? So why would that make sense for you? But again, the 30-second video doesn't show that. The other part is like I said back in the day when I used to sell life insurance, one of the biggest things we would do is say, like when you first came and got your insurance, if you're like in your 20s, whatever, you're a healthy person, whatever, we would not talk you into, but advise you and show you how if I got like $50,000 in a whole life insurance policy and I was ultra preferred, which is that rating, the best rating. So I'm ultra preferred for $50,000 in whole. And then I would get like a 100,000 to $500,000 term rider. As I got older, if I wanted to start converting that term into whole life, I still had the same ultra preferred rating. It just went up by my age. So a young person probably does not need a whole lot of insurance. A young person who doesn't have a wife, doesn't have kids, doesn't have anything like that, you could get away with $50,000 in whole life and, maybe 150,000 in term. But obviously, as you got older, what would you want to do? You want to get more life insurance, right? So when I see, and again, like I said, I don't actually write policy anymore. So I don't actually do presentations, but I have had clients come and bring me presentations about them thinking about buying an IUL or a whole life or anything like that. A great example would be, let's say I'm 40 years old. I'm the breadwinner. I'm making around 100, $150,000 a year. My wife might work, but we have 3 kids. Or let's say my wife doesn't work. I'm the breadwinner. I'm making $150,000 a year. My wife stays at home with the kids, and someone's trying to tell me to get an IUL that is building wealth inside of it, but it only has like a couple $100,000 in life insurance. If I was to pass 6 months from now, my family would get 4 or $500,000. Is that the right policy for me? It's not. Anybody who knows, because again, when you say to yourself, what is life insurance for? The problem nowadays is we don't even talk about protecting your family. When you see people dancing around and talking about the high value of IULs and stuff like that, they're not talking about protecting your family if you die 6 months to a year from now. They talk about being able to borrow money out of it, build wealth into it, and then when you retire, you'll have all this money. But again, they don't talk about if something happened to me today or 6 months from now, is my family protected? And that's funny. I started laughing when you started talking because the first thing you said when you said I have life insurance, what did you say? I don't think my family knows how protected they are if something was to
No,
happen to me.
they don't. They
And
don't need to know
so,
either.
right? But the funny part about that is when you see people get excited about IULs and stuff like that, you never hear them talk about the protection for my family. They talk about, I can borrow this money, put it in here, the money sits in here, and then it's collateral that I can borrow out of that money and go do this, go get this, go buy this apartment complex. And
Could
you
be
have,
my own bank, Eric. I
yeah,
could be
be
my
my
own
own bank,
bank.
right? So I'm doing all this stuff. I have all these moving parts. But again, the common sense part to me is like I said, so great. I have this money sitting in collateral. Are you trying to tell me that I'm not paying any interest on me borrowing my own money? Do you really truly believe that? So I'm not. If I go borrow my own money, that's collateral. I'm paying interest on that money, correct? So whatever rate I'm getting with it sitting, it's going to be cut from me having to pay interest on me borrowing from my own money. It's like a great example of how you can borrow money out of your 401k at work. If you borrow money from out of your own personal 401k, do you have to pay interest on that? Yes, correct. So why would that not work the same way with a life insurance policy? So the main thing you should think about when you are doing that, the first thing when you sit down and someone is talking to you about, like I said, I've actually sat in Zoom meetings, I've sat in group things where people claim they sell insurance and they're financial services professionals and all this and that. If the first thing you are saying to me is about an IUL and we haven't even done a discovery, we haven't talked about my situation, we haven't talked about how much money I make, we haven't even talked about what I would want to happen for my family, what I want my life insurance to do if something was happening to me, you're nothing but a salesperson. Period. Tell me I'm wrong. You're nothing but a salesperson. You're not looking out for the best interest of me and my family. You're just trying to sell me a product. And that's why when you see these videos, what are they doing? Again, they're getting on private jets. They're walking around these mansions. They're making it seem like this is some great generational wealth thing that you're doing, that you're talking people into doing. But you don't even know my situation. A person who is single and has no wife and no kids is definitely a different situation than somebody who, again, the 40-year-old whose wife's a stay at home, stay at home with the kids, and you have 3 kids who are preteens. So why would you give me the same life insurance policy as that person? That makes absolutely no sense. We won't even talk about um, how we want to talk about how with an IUL, it's in the stock market, it's making all this money, making more. It's a better investment than a Roth IRA, traditional IRA. And again, it's not. Because again, if how an IUL works, again, the 30-second commercial is not going to tell you. An IUL has a ceiling and a floor. What that means, right?
Break that down, Eric. Break
So
that
what a
down.
ceiling and a floor is, and again, I know from looking at presentations, a ceiling and a floor is no matter what the stock market does as far as losses. So if I have a Roth and say the Roth takes a 20% loss this year, my floor is basically zero. So my IUL can't lose money, right? That's the good part. But let's say the S&P 500 or something like that is killing it like it's doing right now. My ceiling is like 7%. So no matter how great it's going, I'm only going to get 7%, right? That's the part they don't say when they're dancing around and saying you can't lose money. But just doing the math, if the S&P 500 is running at what, 10 to 12% on average for the last 80 years, how is that better? How is something that maxes out at 7%, how is that better than just putting your money in the S&P 500? But you can borrow from it. Again, that is the whole gig of an IUL. That's what they brag about. I've never seen a video of anybody saying, talks about the life insurance part. I've never seen it. I've never seen a video where anybody talks about the life insurance piece. All they talk about is it's building wealth. You can borrow out of it because it has all this collateral. You can use it whenever you want to use it. You can borrow out of it anytime you want to, all stuff like that. And what they fail to tell you is, because everybody makes you want to believe that you can't take money out of a Roth until you're 59 and a half. And that's absolutely not true. You can take out the principal after 5 years with no penalties and no taxes on it. Because again, it's after-tax dollars, just like putting money into the insurance policy. But again, they don't tell you that part. They try to make you believe that once you start putting money into a Roth, you can't take out any money out of it without paying any penalties until you're 59 and a half, no questions asked.
That's when you get to the K, you have to pay that. You have on that, right?
If it's a traditional 401k, because that's tax deferred money. So again, when you get to retirement age, you got to pay taxes on everything because you haven't paid any taxes at all. So you have to pay taxes on what you put in it and all the gains. So to me, the main thing is when I hear them say this is what wealthy people do that as another retirement vehicle because of what I just said. You're taking after-tax dollars and you're putting it into something that when you take the money out, you don't pay taxes on it. Switch what I just said and say Roth. It's the same thing. It works the same exact way, but the only good part about it is you can put as much money as you want into an IUL, as opposed to, the Roth has limits.
Yeah, 7,000 or so.
And again, an IUL has an insurance piece, but again, that's not talked about. The insurance part is not talked about. All they talk about is being able to borrow out of it and having money for retirement, which is basically what you would be doing with a Roth. You'd be better off, especially depending on how much insurance you actually need. You'd be better off just getting a term policy and opening up a 401k, opening up a Roth, or even open up a brokerage account. True, you got to pay the capital gains and stuff on that, but the only good part, again, like I said, is you're able to put more money into the IUL as opposed to the Roth. But again, even on that regard, when I say to somebody, has someone sat down and tried to sell you an IUL? And they're like, yeah. And I'm like, how much was it a month? How much is it usually, Isaac, when somebody tries to sell that to you?
That's it.
Expensive.
It mostly doesn't fit in our everyday regular budget.
Everything thing, because again, that's how the numbers work. When people say, you're saying I can immediately start taking money out once I put it in, because again, I used to do insurance. So I know that when somebody puts money into a regular whole life or regular IUL, admin fees eats up everything. Again, I've seen presentations and I used to sell it. Admin fees and the commission of the person selling it, that eats up everything. So again, let's say I'm paying $1,000 a month and I have so I'm paying $12,000 annually. And I say, okay, how much money do I have into the policy? Depending on how it's set up, I have no cash in the policy because the admin fees and the commission eats all that up. And then the next year when I put $12,000 in, it might have $8,000 to $10,000 in it. Because again, I'm having to pay all these fees. So again, we're under the impression that the moment I put $12,000 in it, I have $12,000 and I can take that $12,000 out. Here's the crazy part. Here's the rub on that. What's paying the insurance if I can take the $12,000 right back out like that? What's paying for the insurance? See, these are common sense things that if you're watching a 30-second commercial, you don't think about. And again, like I said in the other videos, instead of taking the time to sit down and talk to somebody who has no dog in this hunt, as I say all the time, I'm going to get the same amount of money because I'm fee only, no matter what you do. So I'm not going to try to force you to buy something that's not right for you. That's not the best thing possible for you in your situation. So to tell somebody, even though how I fund it, I can't put $12,000 in a policy and take $12,000 out 6 months later. It doesn't matter how you fund it. It doesn't matter how it's set up because no matter what, I still got to pay commissions, correct? And I still got to pay for the insurance piece, period. So there's no way you can tell me I can put $12,000 into a policy and then take the whole $12,000 back out in 6 months. It doesn't work like that.
So you would recommend someone that
pretty much has, I guess, a certain amount of annual salary? What is there like a certain they've maxed out the
Yeah. It maxed
401k,
out
the
everything
Roth,
else. And
now they
if
got
you're
some
looking
other
for
investments, they probably got some
correct,
property or something like that. Now we're just looking for other ways. They
other
probably got a
investment
CD or
vehicle.
something like that.
Correct.
And then now we're
Wealthy
looking
people.
at, oh, I can just put
Yep.
this money in the IUL,
Wealthy
right?
people.
But what
Correct.
what was that look like? That's a lot of money going into these different places. So what is like a number? I don't know if there is a number for
Yeah,
that,
there's
but
really
is
not
there
a
a number?
number again because it all depends on your situation. Like I said, it's crazy to give somebody a number because then that makes it cookie cutter. It all
Okay.
depends on the situation. So again, like you said, that's what's funny to me is when you see all these people run to go do all this stuff because I'm gonna try to not be rude in saying it. This is what wealthy people do. You're not wealthy. If I said, what do you put into your emergency fund every month? What do you put into your savings account every month? What do you put into a retirement plan every month? But you can somehow pull $2,000 out of your budget to do this? You don't, because what did I say first? I'm gonna go get a loan to put in here to get collateral off of that loan in order for me to borrow and then pay interest. Look at what I'm saying to you right now. Listen to what I'm saying to you right now. I'm gonna go get a loan to put into a policy that's collecting collateral, but if I borrow money out of that collateral, I got to pay interest on that. So I'm paying interest on the original loan and I'm paying interest on the loan that is sitting in here building on this collateral that's building interest. But that's building generational wealth, right? Again, I'm not saying, like I always say all the time, I'm not telling you not to do it. I'm telling you, is that right for you? Is that the right situation for you personally, you specifically? Because what ends up happening, because again, I've sold life insurance before, you end up getting somebody to do these type of things and it's not in their budget and it's not something they can afford. And what happens? It's a chargeback is what anybody who does insurance will tell you. It's called a chargeback because what happens is they can't continue to keep making the payments. And so it implodes or it gets canceled. And the worst part about that is if I'm somebody who gets excited to do this, but let's say you somehow talk me into doing $1,500 a month. And again, the first year, like I said, it has no cash value in it. And I can't continue to keep doing the policy. What happens to the money that I put into it for the admin fees and the commission and all that after a year? That money gone. I don't mean to put it like that money gone.
All that did you put in there? It's all
I've
gone.
seen presentations and I used to sell it. So all the people who aren't here who do not sell it or only been working for 6 months and say I'm lying, I'm not. I'm not. Depending on how it is set up, the first year it has no cash value in it. So if I keep it for a year and then after a year I say, man, this is killing me because again, I didn't think about my budget. I just thought about buying this because I'm watching this video that you're showing me of me doing this. And now come to find out, I really can't afford this. This is killing me. And now I've lost that money. As opposed to me saying, if I really got that type of money, I could just put that into a brokerage account. Or I could put that into a high yield savings account. I could put that into a Roth. That money's only gone. Again, I'm not saying you can put money into a Roth and not lose your money, but I know that money's gone. If I put that money into that and a year later, I can't continue to keep making payments. That money's gone. If I shut that down, because again, it's not like a Roth where I can pay for a Roth for a year and then say, I don't want to put any more money in, right? What happens? That money just rides, right? It just rides. If I
Yeah.
put it in that after a year where it has no cash value in it and I shut it down, not only do I lose my money, I actually lose the insurance as well, right? Because I'm not making payments on, because again, I have to make premiums on the insurance. So I lose that as well.
So, Eric, could you break down what is term insurance and different types of term insurance? If you could just break
So
that down.
for me, the best way of putting it's almost like, again, I always say, because I already know what I want to talk about in later dates. It's like renting and owning a home, which we're going to get into. And this is a perfect example of that. To me, the difference between term and whole, term is basically like renting and whole is owning. What I mean by that is term is cheaper than owning whole life. I go along for a certain amount of time. So let's say I do a 20 or 30-year term. When that term is up, I don't have the insurance anymore, correct? Just like if I rent an apartment, I move out of the apartment, at best, I'm going to get my security deposit back, right? But I've not built up any cash or any wealth staying there. If I own the home, just like a whole life or a IUL, I'm putting money into it. It's growing, it's building equity, all this and that. So I tell people all the time, as long as you continue to make the payments on those type of insurances, just like owning a home, no matter what, I'm going to get my money back, so to speak. I'm either going to sell the home Or in the case of insurance, I'm going to annuitize it and start taking payments. Or if I pass after the time, I'm going to be able to leave that money to somebody, right? Just like if I own a home, I'm able to leave the home to somebody. So just like at a conversation I had in a class I spoke the other day, why would I not own a home as opposed to renting? Because I'm just throwing money away. Because when I get to retirement age or after 30 years, I have no money. But the purpose of what I said at the beginning was what? If I have term, especially for the amount of coverage, term is way less than whole life, especially when you think about the amount of coverage that you have. The problem is you should get term for the coverage, but then you should be investing the rest of the money. And again, an IUL could make that sound kind of right. But again, most people who sell IULs, they're more focused on the money that you're investing and the borrowing and all that stuff, as opposed to the insurance part. I've never seen an IUL that had like $1 million or $1.5 million in term in insurance part, which is what most people need, especially if you're somebody if you're a household that makes six figures, you should not both be walking around with $250,000 policies, correct? If our household makes over six figures, $250,000 is not going to help. It's not going to last a long time. So you should really think about getting as much term as you possibly can, or as much term as once you do a discovery to figure out, to be able to put your kids through college, to be able to pay the house off, to be able to do all these things. You need to figure out how much term you need. And then it's way cheaper than a whole life or an IUL or whatever. But the key is, and this is the most important thing, especially just like if somebody was to say, I'm renting as opposed to owning, the key step that you need to make sure you do, though, is you need to invest consistently. If you don't invest consistently, I can't lie, having a whole life or an IUL, that forces you to build equity because, again, you're overfunding that policy to build that money into it, So if you're not going to be consistent on investing outside of the term, because again, the term is not an investment, the term is protection. So you still need to open up a Roth. You still need to open up a brokerage account. Again, depending on the amount, especially in a brokerage account. Again, I understand you're not going to get the tax savings deal as if you did an IUL. But again, in most cases, if I'm a family, if there's two of us, what is the max on a Roth between two people? $15,000. So are you budgeting putting $1,000 a month, $1,500 a month, or whatever, $1,200 a month into an insurance policy? More than likely not. So to have the conversation of, a Roth doesn't give me enough money. It doesn't give me enough leeway to put enough money into it. You're right. If you're wealthy. But if you're somebody who says, hey, I just need to take coverage. And again, I'm probably doing a 401k at work and all that stuff anyway. So this is just another vehicle for retirement. But again, we get caught up in this is what wealthy people do. This is what wealthy people do. This is what wealthy people do. And you're going to struggle to make the payments because you're not wealthy.
That brings me up to a point because it's like, how can the role of life insurance play in long-term wealth strategy? And so if a person is just making, $50,000 a year, $80,000 a year, and it's like, hey, I'm able to sustain myself. I live, below my means. I'm, doing what I need to do for a 401k. I got my Roth and I'm 30 years old. How can I build long-term wealth strategy if life insurance is involved? Or should there be a different avenue because you talked about earlier as far as investing consistently, but is there something at that age of 30 and making pretty good, decent money, living below your means and really trying to build long-term wealth strategy and probably want to have a family? Like, what would that person need to do if there is I know this is just a scenario, but just what would you kind of do? I know it's not cookie, but just customize something that would be
again, like you're saying,
ideal.
it all depends on the client who's sitting in front of you. So again, if you're 30 and you don't have a wife and kids or anything like that, but again, like you said, you want to be able to have that ability to do that. Again, you might buy, a whole bunch of term today because of the fact that you want to keep your rating and stuff like that. Or you might want to buy like a smaller whole life policy in order to start building wealth into that. And then again, have the term rider to be able to start converting that as you get older, if you want to have the whole life policy. But again, for me personally, I would personally look at life insurance for the protection part of it. There are other vehicles that give you a better return than putting money into an IUL. If I'm somebody who's putting in money into an IUL, it's because I've already maxed out all the other avenues, or I'm putting in way more than what the limits are on doing a Roth IRA or a traditional IRA and stuff like that. If I'm going to put way more money into that than those type of things, then yeah, that might be an avenue. And again, but I would definitely make sure that if I got hit by a truck or something 6 months from now, as crazy as that sounds, it happens. So it's like I used to say to people all the time when I used to sell insurance and somebody would come and they'd be all excited about getting 50, 75, or $100,000 in whole life. But it's a situation where you're the breadwinner or something was to happen to you, your family be in trouble. The question would be, if let's say something happened to you 6 months from now, would you rather me bring your wife a check for $1.5 million or a check for $150,000? That's the conversation, not you save all this money. I mean, not you save all this money. Nope. You're becoming your own bank. That's not the conversation if I'm worried about something happens to my family if I was to die 6 months from now. That's not the conversation. Now, if you have term insurance or you have all this insurance somewhere else or whatever, or you're rich or you're wealthy and rich, so your family's taken care of anyway, and this is just another vehicle, great. But when I think about insurance, I say to myself, insurance to me is for protection. It's not for a wealth building strategy. It's for protection. If you want to say the words generational wealth, great. If you want to say generational wealth, we'll say that, even though I hate using that. But if you want to say generational wealth is not leaving $100,000 to your family. It might seem like a lot because most people don't even have that. But what generational wealth is, if something was to happen to me in the next 30 years, my family has $2.5 million. And if I outlive the term, I've been investing, so now I have more than that in my investments. That's building generational wealth. If you're going to talk to me about generational wealth, that's what generational wealth means to me. Not going to get a whole life policy or an IUL or something like that that only has a couple $100,000 in life insurance part. Let's make sure we understand that part. In life insurance part. So again, like I said, when I see presentations and at the most it has $300,000 or $400,000 in coverage if something was to happen to me, and that's what I say to the person. I said, so you walk out of here and you die, this is what your family gets. Can your family survive off of this? Will your family be good if someone brought them this check? Don't look at when I'm 80 years old, it's worth $5 million. You see what I'm saying? That's the rub. That's where they take you. They take you all the way to that. Now, when I'm 80 years old, my family gets $5 million, or I can start spending that. What happens to you? What happens to your family if something happens to you 6 months from now? So if you're going to do this and you have term that covers all of that, perfect. But again, that's not the conversation. The conversation is I can dump all this money into it. I can overfund it and I can borrow money out of it if I need to borrow money out of it. I'm not saying that part is wrong. The part I'm saying is you need to make sure your family is taken care of. First and foremost, that's what insurance is for, right? If we're being blunt, that is what insurance is for. But again, when we start looking at stuff like this, I hate to say it's a scam. You hate to say that, but when you look at the type of people who are selling these products and trying to do these things, it's usually somebody, again, it's just salespeople. At the end of the day, it's just salespeople. They're not really somebody who's looking out for your best interest, who's really going to sit down and have a conversation with you. Again, you've actually been in meetings with me on Zoom calls and stuff like that. We're sitting around with people and somebody raises their hand and says, hey, I sell insurance. You all need to have IULs and all this and that. And I'm just sitting there shaking my head because again, I'm not even, as you see, I've not one time said an IUL is trash. Have you heard me say that?
No.
Not one time have I said IULs are trash. I said, is it the right policy for you? And that's the part that people miss. Just because somebody's selling you something or telling you how great it is and whatnot, and this is what wealthy people do, again, that's the kicker. This is what wealthy people do. The moment somebody says that, everybody's ears perk up and they say, oh, well, if I want to be wealthy, this is what I got to do.
I think that's the like the mindset in the society and the environment kind of goes to like, well, you got to do what wealthy people do. You got to read the books, try to do the routines to be able to to have that. But there's a lot of things that go into play into being and becoming wealthy, right? There's a lot of different.
And that's the part that's missed.
Especially like to have that type of wealth that what you're trying to, shoot for. So, we can't just keep playing lotto numbers and hoping.
The best example to me is you see all day, everybody says, this is how the Rockefellers maintain their wealth. What's the word that you said? Maintain. They're not wealthy. They didn't become wealthy off of life insurance. Let's be clear. The Rockefellers did not become wealthy because of life insurance. They might be using life insurance to keep their wealth and stuff like that, putting all that, doing the trust and all that drama. Again, another conversation about everybody believing you need to have a trust to protect a business that doesn't make any money. Help me understand.
Trying to get a trust to protect our families because we want to leave a trust
But a lot
and have our grandkids be like,
of people who say that don't own a home, don't have a business that makes any money. So when I say, what are you protecting? What are you protecting? What are you protecting? See, we're going off topic. See what I'm saying? What are you protecting? And if I see one more person tell me how trusts don't pay taxes, we're going to stay on topic. But that's all I'm saying. It's like, I'm not, as you see, I didn't even trash the trust right then. Is a trust the best thing for you? That's what you need to look at. Don't look at this, what all these people do. So I want to be these people. So I got to do this. You need to ask yourself, what is the best situation for me? Because if you're running around chasing what you believe is making everybody else rich, it's going to make you more broke, period. In a discussion. If you run out here and go get all these loans and go buy all these vehicles and go do all this stuff to write it off and do all these things, but you don't have a business that's making the type of money to maintain that, you're just going to be broke. If you're going to run around and you don't have so to get back on the life insurance part, if I don't have an emergency fund, if I don't have a savings account, if I'm telling you I'm struggling to even do the match at my job for my 401k to get the free money of the match, but I let somebody come in and talk to me about putting money into something to be my own bank. And so I don't even have money, but if I put all this money into this, I can automatically become my own bank. You're hustling backwards. And again, what happens? Again, I used to sell insurance, so I know what a chargeback is. And so that's what ends up happening. Someone falls for that and they believe, okay, I can do it. You do it for 2 or 3 months and then you can't afford it. So what do? You don't have to cancel it. If they're trying to draw it out of your account and it's not in there, you don't got to cancel it. They'll cancel it for you. And the money that you put into it is gone. And so again, I'm not trashing the policy. I'm going to say that one more time. I'm not trashing IULs. I'm not trashing whole life policies and stuff like that. I used to sell them. The point is, when you sit down and you look at these videos and you sit down, you talk in front of somebody, if they don't pull out a discovery and start talking about what value it does and all this, that, if the first thing someone who sells you life insurance says to you, how much money can you afford?
That sounds like used car salesman to me, right?
The first thing they say is, how much money can you afford? And then they try to put you, and then they try to make that work. And then again, not one time have they said, how much insurance do you need? Because again, it's a whole different conversation if I need a certain amount of insurance, but I only have this budget. There's certain things you can just wipe out. There's certain type of policies you can just wipe out. You're like, oh, you can't even afford. If you do this, if this is what type of insurance you're looking for at this budget, this is not the policy for you. But that's not the conversation. The conversation is, this is the policy for you. And we're going to try to make your budget do that. And then you end up charging it back because you're not wealthy. So the $1,500, $2,000 a month, that's going to hurt you. That hurts you. It doesn't hurt a wealthy person. Again, like I said, when people used to send me the videos and the people were dancing around talking about, if you put $400 a week into this policy, when you get to such and such amount, you'll be able to take out $100,000 a year in retirement. Why doesn't that work? Oh, you have $20,000. $20,000, 400 times 50 weeks. No calculator neither, right? $400 times 50 weeks a year is what? See how they said 400 a week instead of 20,000? So you're not thinking that's a whole lot of money until that $400.
It's what, 20,000? Right, Eric. I appreciate you. This has been a phenomenal topic for this episode. Is there any final thoughts, any closing thoughts that you would like to add on to this for the folks listening right now? Awesome. Thank you, Eric. I really appreciate this. You're tuning in to the Financial Turtle with Eric Anderson, you guys. I hope you be able to like, subscribe, share this out in all platforms. Please follow us, and we'll be back again for another episode with the Financial Turtle. Y'all have a great day. Bye.
Thanks for tuning in to the Financial Turtle. If you're ready to take that next step towards financial clarity, visit andersontaxes.com. Learn more about our team and connect with us. Make sure you subscribe and share this episode to someone who may need some guidance, some real guidance, not just good sounding advice, you guys. Remember, the goal isn't to just move fast, it's to move smart. Let's be the tortoise, not the hare, like Eric said. and we'll see you next time. Thank you for joining us.